Hi guys, welcome to another episode on FMS Capital. So disclaimer, this channel is just for educational purposes. And also disclaimer, for those who do not know ICT trading, I think it's your task to go to Inner Circle Trader on YouTube and try to learn, try to figure it out. It's not a walk in the park, but I do believe with time, then you may get to these levels that other advanced ICT traders are doing. So anyway, today I just want to do a random talk. And this talk is kind of interesting, especially for me as an ICT trader and for anyone else who's listening and who has been more all about technicals. Yeah, so for a long time, I've been a technical trader, which I am still. And for the most part, I used to ignore something about fundamentals. So I never used to be interested in learning the dynamics of fundamentals. And the notion was that I believed that the technicals would show me what the fundamentals are saying, of which fundamentals and technicals I do believe they go hand in hand, whereby when the fundamentals come in, probably now is when what you're seeing is in the technicals. So nevertheless, today we'll just go through fundamentals a little bit and also we'll look at the XY on the long term in a fundamental way, because I do believe this can help you, especially ICT traders who have been more so on technicals. So maybe you can add this on your arsenal. And remember, with fundamentals, I'm beginning to be interested in this a lot because it helps you understand where the money is flowing and across the world. So probably when their interest rates are for this country are probably a certain amount to another country a certain amount. Imagine you being a long-term investor, or say like someone like Warren Buffett, and you probably want to maybe profit out of maybe um, shares from other countries or maybe loaning other countries. I do believe you need to understand a lot about these fundamentals. So let's dig in. So why keep track of fundamentals? So the main reason why you should keep track of fundamentals, I think, is that on the long run, I do believe it will help you in understanding the large market trends that are coming in, especially now when we call as ICT traders, when we probably saying looking for that draw on the long term. I do believe if you add some fundamentals in it, your draw can be even so easier to get. So there's currently some economic indicators that I think every trader at least needs to know. So these indicators are, for the most part, I like looking at gross domestic GDP. And with GDP, basically it measures the total value of all goods and services produced within a country for a specific period. And this could range or typically could range between a year or a quarter. So this is a very key indicator of a country's economic health and activity. It's very key. And that's why you will realize that a lot of fundamentals, when you learn about the growth of an economy with using now GDP, you may understand probably days when, or probably years, or probably quarters whereby maybe the country is in an expansion phase where it's performing well, and Sometimes you can find it's in a contracting phase, whereby everything is tumbling, GDP is not good. And I do believe right now with what US, I do think they're in between, or let's say just right now, I think they're in the phase of contraction. And we look at it because I do believe they had a very good expansion on 2023, whereby you'll see that their GDP used to just be every quarter, like Q1, Q2, Q3, Q4 was always increasing. So that's why you will find out probably at that 2023, there was no any issue about rate cuts or whatsoever. Yeah. So anyway, the other one is consumer spending. So this is the total amount of money spent by households on goods and services, and it's a significant component of the GDP as it accounts for a larger portion of the economic activity on it. So you'll find out that consumer spending um, is basically influenced by factors like um, factors like consumer confidence, what else? Interest rates, and I think those, and what else? Income levels. Yeah, so income levels also. So another economic indicator is unemployment rate. So, and basically with unemployment rate, it represents the percentage of labor force that is unemployed and actively seeking work. So basically, you'll always find that I like looking at an employment rate because it shows you the general health of the workers. So you find out that whenever, let's say, unemployment is increasing, would be a key significant to looking at probably the country is weakening, so the GDP probably is not performing as it's supposed to, right? So the other one could be the consumer price index. So this one is very simple. It just measures the changes in price level of baskets of consumer goods and services over time. So it's like it's a key indicator to measure inflation. Um, and inflation is something very, very key in looking at if you are trying to do some fundamental analysis. And for right now, for example, let's say now if you look at USA, the I think start of Q4 of 2023, I think that was probably the beginning of the topping of the inflation that was high. So for the most part, we have been dropping on the inflation, and I think right now I think we are about around 2.9. Yeah, and always the target for the Feds when looking at inflation is always at 2%. They want it to be at around 2%. So I think right now we are at 2.9, somewhere there. So the other one is still NFP. So NFP refers to the number of jobs in the economy, excluding those in agriculture, government, and other few other categories. So also this NFP is a very, very, very key indicator. It gauges the strength of labor markets. And lastly, we have interest rates. So for the most part, I always like looking at GDP, unemployment rate, consumer price index, and also NFP and interest rates. So I think those are very simple indicators that probably if you like to learn, you can dig further and look at them. And with GDP, so I'll use the example of US. So I was saying that probably US, for the most part, during this expansion, US has been performing, their GDP has been improving. 2023, all this time it was improving. So for now, I think it's in a contraction phase. So think of it of why contraction? Because remember, the Fed, while they are the key pillars of determining interest rates, they do this on the basis of looking at these economic indicators. So if GDP, let's say, for example, if GDP is not performing, yes, let's say US GDP is not performing well. So what do you think is the best criteria for them to undertake on the interest rates? So for the most part, you may find that they will probably want to cut rates so as to have a cushion or try to revive the economy, right? So I do believe because now there could be some contraction that is happening, and basically also we could end up in a depression or a recession. And basically a recession is whereby, let's say, in a full year, probably we have 2 negative GDP. Let's say probably Q1, Q2 comes negative. Then Q4 probably, even if it comes negative, that will be even worse, you know. So that could result to a recession. And you'll find out that all this is just a cycle. And you'll find out that when they are always in an expansion phase, they always like to hike rates to cap the inflation that is going to be on the expansion, right? And so the hiking of rates can result to now the contraction of the economies, whereby now GDP contracts, US GDP contracts, so they are forced to cut rates. So when you're doing your fundamental analysis, you need to look at these key indicators and try to now to interpret in your own way of the general feel or the sentiments of these fundamentals. So that's like you understanding where the money is flowing, right? Then technicals, because we are an ICT trader, it's now even simpler to understand. Probably maybe this liquidity is where they want to reach, or probably that liquidity will be used to engineer some reversals for the market. So I do believe you need to look at these ones. So for example, this is the United States GDP annual growth rate. And we'll look at 2023. You can see like around 2023, and this is Q1 of 2023. This is Q2, Q3, and Q4 of 2023. So you can see that we have always just having that general up move on it for the whole part of 2023. If you look back around 2022, we had a general view of sloping to the downside. So now here is Q1, Q2 of 2024. There's just a slighter as we wait now for the results for Q3, right? So basically, on the GDP, if I could summarize this, I could say probably for now, GDP is still okay on their part. So you're always also looking at other indicators like inflation, what is happening to inflation. So for example, let's say Q3 comes negative. Let's say because now I think we are around 3. So let's say if Q3 comes to a negative, we have a sloping. Then that could fundamentally interpret for me that probably the economy is probably, yes, it's not performing well, and probably could be ending up in a contraction phase, which could end up for the Fed to hike to cut interest rates. And that results to what? To dollar weakening, right? So it's a very, 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 I think it's very simple, not hard. If you just continue reading and trying to understand. Um, so for example, this is the United States inflation rate. You can see from since 1914 all the way to now, how the inflation rate has always been. And this black line that you see here, this one, horizontal one, this is 2%. So the Fed like to at least see inflation on the figures of 2% on this line. So going below 2% means that the country could be in a recession phase, most probably, for the most part. So even going below 2%, or for the most part, let's say going below zero, going to the negatives, I think could spiral to a recession. For example, for I think these areas, for the most part, was a spiral to recessions. So even in recessions, it's tough for everyone. So currently, if you can see, I think, yeah, we are at around 2.9, like I was saying, 2.9. And you can see the general view seems that them hiking rates has really improved in reducing the inflation, as you can see, as it goes towards their target of 2%, right? So also this is a graph on unemployment rate. So we can just use, for example, for case study, what has happened this week, because we had an announcement on unemployment rate on Friday and also NFP. So if you look July to August, there was a downward slope. So you needed to interpret this as what could be happening. So if to the dollar on a basis of reduction. So unemployment went from 4.3 to 4.2. What does that mean for a country's currency? That means that probably jobs were created, means that employment reduced, which means that the dollar strengthens. And that's why you see all the action that happened last Friday. It was very simple. Now imagine you understanding that, and plus understanding now your ICT technicals. So it gives you more confidence of holding your setup, and you will see. Once you understand these fundamentals and try to key in, for the most part, I think it's going to take some time, but with time you dig in and you dig in, it all will gonna make sense. So the other chart, this one is on the federal funds rates since 1954. And the good thing about this chart, and we'll go to the charts and you see, the good thing about this chart on the Fed funds rate history, it's like a replica of the dollar. So basically, when they're hiking rates, dollar gains. When they are cutting rates, dollar weakens, right? It's like typically a replica of of the dollar index chart. So I want us to go to the charts, and I'll show you that example very clearly. So this is dollar index. So if you look at this, this is dollar index on the above, and this is the Fed fund rates below. So if you look at technically what this chart is showing, it's just showing a replica of each other. It's like a mirror of each other. So after COVID 2020, around, I think around here, when they were cutting rates, after COVID came probably there, after COVID ended, there was a series of a rate cycle whereby the dollar was, the Fed were hiking rates. So this was the cycle, I do believe, of the hiking rates. And that is still the same cycle if you look at this buying that happened on the dollar, this point, 2020. And remember, these candles are 12 months. So each candle represents a year. So 2021, 2022 was a series or an environment of hike rates. So fundamentally, as a long-term investor, you need to understand that we are in a rate hike cycle. And before even you would understand you in a rate hike cycle, the key indicators like inflation, like GDP itself, NFP, unemployment rate would have given you that signal to understand probably what the Fed could be trying to do depending with those data. So 2020, after end of 2020 to 2021, there was a series of rate hikes. So now, if you ask yourself right now, what is the mood, especially what is coming this September? I think now probably even retailers understand now probably there's a rate cut that is coming after many years of hikes. Maybe now we have finally having a rate cut, right? And you can see since those sentiments, because remember, if you understood fundamentals, the key indicators that were happening, you could understand that probably now with the GDP and with the inflation reducing, then probably it's high time to cut rates. So an NFP of when? For the other month was a deal breaker. I think that was a very deal breaker for Powell now to come. Probably, I think that was around August, signaling probably a rate cut is due. So I think that was a deal breaker for them. So what I do believe is, I think now we'll have now that series of rate cuts. So it's gonna be a cycle of rate cuts. So with this cycle of rate cuts, what I do believe is, I think 2025 probably also, yeah, let's say 2025. I think we'll just have that general selling of dollar, the long-term basis. So that could be now signifying a risk on scenario for the next probably 1 year or 2 years. That's what I think, a risk on. So whereby things like the ones that trade against the dollar, probably like EU, GU, gold skyrockets, Bitcoin probably gains, or else. So anything that is against the dollar, because now you're in a risk on scenario, will propel. But that's what I feel. I feel for what's gonna happen. So I think maybe we can just look at it on the analysis side, and probably on these lower time frames. I think we'll just go to daily, because now long-term trading is kind of different with day trading, because now there's the zeal and the patience to wait, especially a long-term trader waits and waits and waits. So anyway, remember, I also want to keep point that when you're looking at these fundamentals, there's that Forex Factory calendar. And when you're using this Forex Factory calendar, I'll use the example of last week, actually this week that passed, and we'll look at what the actuals, the forecast, and the previous were saying. So I think one thing that was interesting for me was Friday. So we'll go to Friday and we'll just look at CAD. See, so we'll look at CAD. No, yeah, we'll go to Wednesday and look at CAD, because on CAD they had an interest rate whereby the previous was at 4.5. Economics were focusing at 4.2. The actual came at 4.25. So basically, it was a cut of 0.25 basis point. So when they are cutting, what does it mean for the CAD? It weakens. When you're cutting rates, the country's currency weakens. So that was a key indicator. Then came Friday, unemployment rates on Friday. So on unemployment rate on Friday, remember, the previous one was at 6.4. The forecast was at 6.5. So generally, before even the actual came, you could have an idea that the economics are forecasting at least an increase in unemployment rate. So if unemployment is increasing, what does it mean? It means even the country is going to worse states, which means they need to cut rates further, which results to what? CAD weakening. And actually now the actual came at 6.6, right? So what else? So these were key indicators for me to look at USD CAD and probably buy it. And I remember Friday it bought way up. It really bought way up. So another indicator, another was NFP. So like NFP, remember, if you look at 4.3, this was the previous one. Economics were focusing at 4.2. Before the actual event was released, we could have already understood that probably unemployment is reducing on their end. And probably now, if you had probably now looking at DXY, because I was anticipating buys on DXY this Friday. So you could probably have used a discounted area on just basis of this information. You see? So when the actual comes and it's the same or even greater, no, lesser, sorry, for this, even if it's lesser, could have signified a lot of dollar buying. And that's what happened on Friday. Because now even NFP, look at NFP. Let's maximize it a little bit. So if you look at NFP, the previous 89K, the actual, the forecast was 164. Yes, they were predicting a higher NFP, which if you're predicting a higher NFP results to what? An actual greater than forecast is good for the currency. They even explain to you right here on the usual effect of an increase in NFP. So when the actual came was 142, yes, it was less than the forecast, but still was an increase on it. So that could still, for me, signify a greater dollar gains. Like dollar gains on that day could be ideal for me. So it's me now looking if probably the Excel was at a discounted area for me to materialize on that setup. And now if we go back to DXY, you can look what all of Friday was all about. Because we had a lot of discounted areas to use. For example, you could have used this OB on that specific news release on that day. So this could already fuel your already buy scenarios and looking for draws if you are a day trader like me, for the most part. Now think of it, and ICT Concepts has a lot of things you need to understand. So some things I will mention here, and probably you'll be like, for newbies, you'll be like, what is this guy saying? That's why I'm telling you, guys go and study ICT himself, and you'll understand at least what I'm trying to tell you guys. So anyway, like I was saying, so on the analysis of this, what I'm thinking with whatever information that I had of the previous, I think 2 weeks on dollar. So last week, around August 29th was this candle. There was a news release on the prelim GDP of US, which was positive. And that's what probably fueled at least even the 2 days of buying right here. Then again, we have NFP, and unemployment rate was low. So this became another fuel for it. So nevertheless, I think what I'm thinking now is probably because of that, maybe the sentiments are probably the Fed may not cut rates that faster. So the September will have been priced in. So what I'm thinking so far, I'm thinking in that scenarios, these scenarios, to the buy side, especially now to revisit the IPTA data ranges for the last 3 months. So this is August, this is July, and this is June. So that's what I'm thinking. Before now we continue the selling, the long-term sales. So something like probably this being our first target, maybe continuations, at least fill probably 50% of this range, because for the last 60 days, this is the highest high and the lowest low. So at least maybe I think around 50% is around somewhere there. So that we can get at least good other probably premium areas to continue selling. So nevertheless, remember, with time, you're gonna understand these things. So anyway, let's see, and may you have a peaceful week.